In this week's update, the need for quality has never been more acute, and this is why. Markets still on a pro-risk stance, and precious metals consolidating. My name is Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. All right, a bit of a shorter version this week. Not a lot has changed. The bull market is still intact. Let's just have a look at where the odds are pointing for the medium and longer term, because the short term is, of course, always a little bit uncertain these days. We've seen recently some very strong moves to the downside, but it's important to distinguish between a savage move that is due to fundamental change and one that's just part of transient factors. And certainly the recent move down was really more about excess leverage. Yes, it was a valuation reset. That was the trigger. But without the excess leverage, the move to the downside would not have been anything like what it was. So don't mistake those very sharp moves for something being wrong with the stock or with the stock market as a whole, because it's generally not the case. And it's probably more likely to be just temporary forced selling. So stay with the long-term themes. And I know it's hard, but try and resist getting shaken out by this abrupt volatility that is actually not part of a new trend. So from my perspective, the market has still got a buy the dips kind of bias. You might want to be a bit more conservative and wait for a bigger dip. And if you don't get it, well, so be it. You don't have to own that stock. You can buy something else where you do get a bigger dip. But we've got US earnings that are really coming through very resiliently, and they're supporting the market. So that's important. You just need to be more selective about what you do is the message. And also too, 2026 is really shaping up as a great year for resources, whether they be producers or developers. I think it'll be a really solid year because a lot of things that have been building for a couple of years are now starting to all come together. Now, as always, there's some long-term risks. In the shorter term, a US rate cut is now looking highly likely. We saw the Fed's preferred measure of inflation, which is the PCE, the personal consumption expenditure, and that's on a bit of a downtrend, on a bit of a cooling trend, so that's good. And that certainly raises the odds that there'll be a December rate cut. But the risk is, if the Fed either doesn't cut or puts some language around it the market wasn't expecting, then that December rate cut is already partially priced in. So I think the market's going to take that very kindly if there is no rate cut or if there are some qualifiers to that. So that's one to watch very carefully, and that's coming up next week. The other major factor, which is longer term but could be far, far bigger than a lot of things that we've seen in the last 5 years, is that the Japanese carry trade, which is where long-term investors or speculative investors borrow in Japanese currency and buy assets, being that stocks or other things, but heavily stocks, in other countries. And so that liquidity has been a big part of what's been supporting particularly the US market. Now, Japanese bond yields are moving up. This is not something that's going to break overnight, but if this trend continues, then that is going to significantly change the way that money flows around the world into equities markets. And that won't be a particularly good trend for equities. So it will impact global money flows, but that is one to not be too concerned about at the moment, but it is certainly one that bears watching as an early indicator that we may be going into more difficult circumstances for equities. The big opportunity for 2026, for me, it's precious metals, it's copper, it's critical metals, but it's so important, I've been saying this for weeks now, it's so important that you only focus on the standouts, because there's so many stocks to choose from that they can't all be supported. So I just can't see that this is going to be a rising sector tide is going to lift all stocks. You want to be on the standouts, the ones that have got a particular reason for investors to back them more than the next guy. So you need to identify them, you need to buy them well, and buy them with a repeatable plan, something that you can just do over and over again. You don't have to be too creative each time. And success, as always, is just so much about managing to a comfortable risk level. If you're not comfortable with what you're doing, you will make mistakes. You will make really poor decisions that you'll look back on. So exposures, the way that you balance your portfolio between different sectors and the way that you weight individual stocks in your portfolio is really, really critical to your success. And that just leads in nicely to the really important message, and that's that before you embark on investing, you really need to get all your support mechanisms in place and look at your investment and your financial and your legal advice before proceeding. All right, let's look at American stocks now. The S&P was up just a little bit, 0.3 for the week. The NASDAQ did a little bit better as we saw a bounce in particularly the tech stock sector. The Russell was also up by a similar amount, around about 1%. So the recent wobble that we've seen, which was really a valuation reset, and it really should be seen as a good thing. I know a lot of people panicked about it, but it should really be seen as a good thing because the fundamentals around these companies hasn't really changed. But what has really driven a lot of that rebound from the valuation reset is the fact that the market is now putting about an 87% chance of a December rate cut. And that, probably more than anything else, has saved the market. And if you think back to last week, I was talking about how this would play out. And it's likely that we're going to get some margin compression, which we've seen a bit of, not a great deal, but we've seen a bit of margin compression. But the rest of it is just letting the strong earnings catch up to the share price. So we may not see anything too dramatic in that valuation reset. But if the Fed doesn't come through with a rate cut next week, then look out below. I think the market reaction could be quite savage. There was also a very strong bounce for semiconductors, and SMH is the semiconductor index. But liquidity is drying up. Is that seasonal? Is it because we're getting closer to Christmas? There's not as much money being put to work in the market, or is it something else? And I don't know the answer to that, but when we get to the chart, you'll see I'm just observing that the volumes have been dropping quite dramatically in this SMH ETF and indeed in individual stocks as well. Now, the US dollar index finished at 99. The 10-year yield actually went up a little bit, I think, from the previous week to 4.14. And the VIX index fell further to 15.4. And it was only 2 weeks ago that it was sitting around 23. So that's been a very significant move in a short space of time. Let's go and look at some charts. This is the NASDAQ on a weekly chart. So you can see we have bounced now for 2 weeks and we're not that far off the all-time highs. So there's not been a lot of margin compression here. But this is largely about expectation of the Fed next week. So that's the key. When we look at SMH, you can see on a weekly chart, it's been 2 very strong bounce back weeks and we're almost basically line ball with all-time highs. But look at the volumes. So we had really quite strong volumes on the down, on the 3 weeks to the downside. And whilst this is very positive trading action, it's really dropping away. Now, is that because of seasonality or is that because there's just not as many people that are buying into the narrative? We'll have to wait and see. The American market over the last month, there's no real dramatic change there since last week. Communication services has done well, and also XLY and XLK have rebounded very strongly. In Australia, over the last quarter, materials have done really well, with a lot of that coming from last week with stocks like BHP and Rio getting some enormous support, largely around iron ore, which has been solid, but predominantly copper, which has moved up. So to do well locally, you need to be a really good stock picker with a consistent entry regime. That's what I was really saying before. And also, most importantly, the hardest thing for investors to do is to take their exit if and when the time comes in a repeatable way, rather than a method that's just driven by emotions. It just doesn't work. So that's how the Aussie market looks. The S&P up a little bit and also almost on all-time highs as well. And there's the Russell doing something similar. So all 3 main US indices just within a whisker of all-time highs, which makes a statement in itself, really. Turning now to the currencies, there's the US dollar. Not a lot of change in the US dollar, but certainly the Australian dollar did move up a little bit, and the circumstances for the Australian dollar are more positive. And while I'm here, let's just look at the ASX 200. This is on a weekly chart, so you can see almost no change there at all. And it's certainly underperforming the US. The US has bounced back to basically its all-time highs. The Australian market didn't move very much. And there's been a large part of that is because of the drag by the money flowing out of the banking sector. Turning now to Aussie stocks, 65.72, so we're certainly moving up. And those forces look like a trend, really, from a fundamental point of view, because the Australian dollar does well when commodity strength is there. I think we'll see more commodity strength in 2026. And also the US dollar, the bias is down. It's in a little bit of a counter trend move at the moment, but the bigger picture trend is to the downside. So there are certainly forces pushing the Australian dollar up. And there's also been an abrupt shift in the expectations around bond yields as well. The Australian 10-year has moved up as well. And to underpin that, we've gone from a rate cut only a few months ago, or the expectation of a rate cut a few months ago, to now the narrative is very much around a potential rate hike by the end of calendar year 2026. So that will not be helpful for the Australian equities market either. Our index managed to put on a little bit, led by materials, IT and staples, but the banks were the drag. So as I keep saying every week, it's really so important to be in quality stocks, because quality stocks are going to outperform. The lower quality stocks in a stressed environment are just not going to do well, and some of them are going to do very badly. So as much as you can, you want to move more towards the quality end of the spectrum. And that means good solid balance sheets and good earnings growth. But the big opportunity for me is in small caps. This is a really exciting area, and especially in resources. But they got to be standouts. And to underscore that, we're looking at early stage stocks. So in the Insiders Club, we've got 3 portfolios, core portfolios for Australia and the US, which are almost totally existing profitable stocks. And then we've got the early stage portfolio where we've got resource development stocks covering copper, gold, silver, antimony, tin, lithium. Nothing in there at the moment. Lithium has made a significant move in recent months, but we've got this overhang in the lithium market of a lot of potential output that's been on care and maintenance that can be switched back on very quickly. So I've been skeptical, as I've been saying, with the lithium market, because I'm concerned about the fact that the higher prices are going to bring a lot of that production potential back into play. So just be careful with lithium, but it's certainly a sector that I'm watching more now than I was before. And uranium is the other one. And I think uranium has been a no-brainer for probably 5 years. I first started on the uranium bandwagon about 2019 and have been in and out of it a couple of times. It's not easy, particularly in the Australian market, because we've either got stocks that are in Africa that have got significant sovereign risk, or we've got stocks in Australia that, for varying reasons, just going all that well, and there's question marks over their production. So the uranium market is difficult, and perhaps an ETF is one way to go in that respect. The other area is cutting-edge technologies, particularly in the industrial and the medical advancement area, and there's some absolutely stunning new technologies that are getting very close to commercialization. So that's a terrific area. So for anyone interested in getting more insight into where the opportunities are, getting a more supportive environment, then the Insiders Club certainly can provide that. We've got a dedicated ESB portfolio for Australia, if that's your thing. And it's producing some excellent results. And I'll just show that in a minute. We've got a very large list of qualified standouts. So we've got quite a number of stocks in that early stage basket portfolio, but we've probably got 2 or 3 times as many that have been qualified, that tick all my boxes, and they're just waiting on the sidelines for more appropriate entry opportunities. So if you'd like more information about that in particular, then get in touch with us. And there is a snapshot of how the ESB portfolio has been performing over the last 3 years. The key number over here is the profit factor, which is nearly 3. And for anyone that's not familiar with that, a profit factor above 2, 2.5 is really solid. Once you start getting up 3 and above, it's really exceptional results. Overall, with both closed and open positions, and naturally with these sort of stocks, in the early years, you're going to have more closed positions that have failed, that have not worked out. That's just normal for this area. But what's open at the moment is 80% of the stocks on the winning side and only 20% on the losing side. But it's the ratio between the size of the winners, in this case 102% versus 24%. So the open winners are nearly 4 times bigger than the open stocks that are in a losing position at this point in time. So it's the Australian market. Turning now to precious metals. Gold was down $18 for the week to just a tick under 4,200. In Australian dollars, because our dollar moved up, then that took $100 off the Australian dollar gold price, but it's still very solid. Silver gained 3.3, got very, very close to $60 at one stage. And the other really interesting and important development is that the gold and silver ratio is falling, and it's falling very sharply at the moment. It's down now to 72. Gold stocks, it was a bit of a consolidation week, so not a lot happened there. Let's go and look at the charts. And we'll start with silver, first of all. So silver on a weekly chart. And if we go back about 5 years to just post-COVID, and silver was trading around about the $14 mark, just around about here. This was just post-COVID in here. So trading around the $14 mark, and this is the gold price also on a weekly chart. You can see it was down slightly. But the interesting thing here is the ratio between gold and silver. Back in March of 2020, so when the real panic was on around COVID, gold was trading at $16.80, silver was at $14. So we've moved enormously in 5 years. We had a recent spike in the ratio between gold and silver. So a ratio of just over 100 meant that it would cost you 100 ounces of silver to buy an ounce of gold. But you can see how this ratio is correcting itself. And long term, the ratio sits somewhere between 45 and 65 is where the normal is. So where we've been for a long period of time is well above that norm. But we're now getting a very sharp reversion to the mean, which means that if gold moves up and this ratio continues to fall, then silver must be really rocketing. And we've certainly seen some very abrupt moves in silver of late. So that consolidation that we've seen in the last week, where on a couple of days stock prices went down when the gold and silver price went up, which is on the surface looks a bit of a head scratcher, but isn't really when you understand they're just consolidating. You've got some profit takers taking some money off the top. Turning now to other commodities, copper had a real spike up to $5.37. We've got currently lost production due to weather events, due to industrial action, due to a number of things, and also some companies providing some guidance cuts as well of nearly 1.1 million tonnes. And that is the equivalent of about 5% of global output. Now, you can't afford to take 5% of global output off the deck when you've already got a bit of a supply squeeze, and we've got a supply squeeze at the moment, and we've got a long-term structural deficit. So the outlook for copper, I'm not talking about on a day-to-day or a week-by-week basis, but over the next 2 to 5 years, the outlook for copper really is very, very attractive. And if we look at 2025 as it draws to a close, the LME futures, London Metals Exchange futures, are up 27% year to date. And the inventory levels are down by 42, and that's why the futures are so high. And that's a very significant move for the London Metals Exchange. Crude oil gained a little bit, back up to 60. But look, we're getting absolutely ridiculous swings in the forecast from investment banks for the price. It wasn't all that long ago that some investment houses were talking about oil prices well in excess of 200, and now we've got them pointing to levels below 50. They're just crazy, and that just underlines again the difficulty in having confidence in this sector when you're investing. So I think it's probably just a management issue. I think OPEC will probably step in here and try and hold the price somewhere within an acceptable range. But my view is that the oil price is unlikely to be really buoyant, and it's probably likely to be closer to 60 than it is to 80 or 90. So for me, it's just too hard. Move on, find another sector where you don't have the uncertainties that sector has. Here's the copper chart. You can see we've moved up really quite strongly over the last couple of weeks. Wrapping things up, risk management is the key, as always. And this is the slide that I had from last week. Nothing's changed. But I think it's important just to go over it again. Get rid of the expensive stuff and the really crowded trades, crowded investments, the ones that are a hot topic on social media. You want to try and avoid those if you can. You want to really seek balance sheet quality and use the dips. If you're rebalancing your portfolio, then be more selective and use the dips for the purpose of rebalancing or rotation. I think it's okay to be close to fully invested at the moment. I don't see any reason why not, as long as you are in the best of the best kind of stocks that stand out in the crowd. Portfolio analyst last week, we looked at how to manage Aussie tech stocks that have been in the firing line of this very significant reset in valuation. And some of the moves there have been disturbingly deep, but the fundamentals remain unchanged. So it's really just a matter of how you manage your weightings. And we also looked at gold trades as well. So that's it for this week. There's more information on the website, and there's my email address. And I'll be back with you next Sunday. Cheers.